Hi everyone, my name is Sarah Grantham, Nordic Trustee in the UK. I'm here with my colleague Kevin Butler, who heads up the capital markets team for Europe. Now, Kevin, we've seen a lot of growth in the SRT market. Can you talk a bit about what's driving that?
Yeah, thanks, Sarah. Yeah, we're seeing huge, as you said, we're seeing huge growth in this space. We're seeing banks, tier one banks, and also kind of mid-tier and smaller tier banks looking at their balance sheets and trying to work out how do they manage their risk, both the risk in terms of credit risk, but also the amount of regulatory capital that they need to hold against those assets. As you mentioned, SRT stands for significant risk transfer, and we're seeing a huge element of that transfer happening where these banks are looking at third-party investors to come in and actually support their balance sheets.
And we're also seeing that the insurance companies are playing an increasingly visible role as well in the European SRT market. What's driving that?
What we're seeing it with them is they're coming into the market providing protection, insurance protection against the transactions. Generally, the structuring that we see are the funded transactions, where an SPV needs to be set up. A third-party borrower will come in and actually support the transaction with financing, and that financing is then protected by the insurance company. The insurance company like this type of business because it's completely uncorrelated to the rest of their portfolio. So they're seeing this as a diversification play from their overall global balance sheet. And relatively speaking, the amounts of credit that we're talking about are relatively small to the global size of their book.
And we have been building out that kind of infrastructure at Accorian.
Yeah, no, we have. As I mentioned a little while ago, we're seeing structures across multiple geographies, but predominantly we're seeing huge focus on Luxembourg, and our expertise is really starting to become noticed by the market participants. To date, we've closed 10 deals in that space, and pipeline continues to improve and momentum is clear.
And can you walk us through how these deal structures actually work?
Yeah, at their core, they're a securitization vehicle and securitization structure. What we're seeing in terms of the structuring is an origination bank will issue a credit-linked note with a reference to a pool of assets that they're looking to move off balance sheet. That credit-linked note is then funded by a third-party financing structure, and wrapping all around it is an insurance wrapper, which allows the risk to be ultimately carried by the insurance company.
So it's funded protection and the insurance company is the real risk taker.
Correct.
So do insurers actually prefer this approach, or is it something they're being pushed into doing?
Honestly, insurers actually prefer an unfunded structure. In some ways, because the funded structures add to the operational complexity, but also to the cost of running the transaction, where you're having to get an additional third-party financier into the structure. But under the STS regime, and some of the ambiguity as to the capital relief that the origination bank can actually take, the origination banks plus the regulators prefer to see funded structures.
Okay. And what about pricing? Is the growing insurance pressure contributing to changing the economics of these?
Absolutely. What we're seeing in terms of pricing is that the pricing is being condensed, and that's having an impact on the economics of all of these transactions. As I said, you've got an insurance company who's able to come in with a different set of economics, different regulatory environment in terms of how they operate. And that allows them to come in and actually provide some real clear pricing benefits.
So funds are being pushed out then?
No, they're actually it's a question of the funds evolving. So what we're seeing in that space is the funds are actually starting to embrace the insurance companies as well, and using the insurance companies to reduce their own cost of finance.
And what about the regulatory picture? There's still quite a lot of uncertainty about this space.
There is, and I think that uncertainty is going to continue for a little while. But what is interesting is it's not stopping the market from moving forward. Like I said, we're seeing a marketplace that is it has that ambiguity, but it's found a path forward. And that's what I love about about this area. It will always find a solution. As said, the market in this space has found a solution using these funded transactions with the use of the securitization regulations across Europe, and that's that's the space that we're playing in today.
And are there other structural considerations once these vehicles get set up?
Yeah, so really what we're looking at there is the jurisdiction and the insurance product itself, whether it's a pure insurance product or whether it's a financial guarantee that the insurance companies are using. With insurance, and the jurisdiction matters, particularly when it comes to insurance products, and whether or not the IPT, insurance premium tax, is going to have an impact. You've got jurisdictions like Germany with very high IPT rates. Luxembourg's got 4%, and then you've got Jersey, Bermuda with 0%. So in terms of keeping the economics working, where you're using a Lloyd's consortium or a direct insurance products, jurisdictions really do matter.
And stepping back then, how significant is this shift for the financial system as a whole?
It is very significant. As I said, we're now seeing the insurance companies coming into a space and a part of the market where they haven't played in predominantly before, being the structured credit market. From their point of view, as I mentioned earlier, they're seeing diversification on their portfolio, which is what they're looking for. Well, they're looking both for diversification, but also fee income associated with this. As you mentioned earlier, the pricing then that it's able to provide to the originating bank, and ultimately that should feed back to consumers.
And what about the broader outlook for insurer participation in SRTs?
The insurance participation is here to stay. As I mentioned a moment ago, the insurance companies are looking at this and seeing this as a real positive. But we're also seeing the market and the originating banks and lending banks seeing this as a positive. The price is reducing, which allows consumers to get the benefit of that. And I think that just benefits the entire economy.
Exactly. And thank you everyone for watching.